RRSP, FHSA, TFSA. Sound familiar? Of course they do. You hear these acronyms everywhere by money experts, your bank, maybe your boss. It gets confusing, right? And that fear of making a wrong move, of putting your cash in the wrong bucket, it's very real. But what if I told you there's a good chance you're leaving thousands on the table by not using these accounts in the right order? What if the difference between a good retirement and a truly wealthy one isn't just about how much you save, but where you save it first? The truth is, most Canadians aren't using these accounts to their full potential. They're missing free money and losing huge chunks to taxes they didn't have to pay. So stick with me for the next few minutes. I'm going to give you a simple, step-by-step game plan that shows you exactly where your next dollar should go. No more guesswork, no confusion, just a clear path forward. Let's kick things off with the one rule that could score you a 100% return instantly. Before we even get into the TFSA, RRSP, or FHSA, we need to talk about the single best deal in Canadian finance, the employer RRSP match. If your company offers a program where they match your RRSP contributions, this is your absolute no questions asked #1 priority. Think about it. If your employer says, for every dollar you put in, we'll put in a dollar too, you're getting a 100% return on your money before it's even invested. There isn't a stock, a fund, or a GIC on the planet that can guarantee you a 100% return. This is literally free money. So, the first step in our ultimate contribution strategy is dead simple. Do you have an employer RRSP match? If the answer is yes, you contribute exactly enough to get the full match. Not a penny more and definitely not a penny less. Max out that match. Once you've done that, and only then can you move on to the next step. All right, you've snagged the free money. Now let's break down the three main accounts. Knowing what each one is built for is the key to using them like a pro. Part A, the TFSA, your flexibility tool. First up, the tax-free savings account, or TFSA. Honestly, the name is a bit misleading. Don't think of it as a savings account. Think of it as an tax-free investment account. For 2026, the annual contribution limit is $7,000. Here's the TFSA magic. You put in after-tax money, so you don't get a tax deduction today. But once that money's in the account, any growth it makes from interest, dividends, or stock gains is 100% tax-free. And when you pull it out, also totally tax-free. This makes the TFSA your ultimate tool for flexibility. It's perfect for medium to long-term goals. Saving for a car in a few years, a down payment on a property that isn't your first home, building a serious emergency fund, the TFSA is your best friend. A killer feature is that when you withdraw money, you get that contribution room back the next calendar year. So if you have a $10,000 emergency and need to pull that money out on January 1st of next year, you can put that $10,000 back in plus the new annual limit. For anyone who's been eligible since 2009, the total cumulative contribution room in 2026 is a whopping $102,000. Part B, the RRSP, your tax deferral powerhouse. Next, the Registered Retirement Savings Plan, or RRSP. This is the OG of Canadian investment accounts, designed for one main thing, retirement. The whole game with the RRSP is tax deferral. You contribute with pre-tax dollars, which means every dollar you put into your RRSP gets deducted from your taxable income for the year. This often results in a nice tax refund. For 2026, you can contribute up to 18% of your income earned in the previous year, with the dollar limit capped at $33,810. Your money then grows tax-deferred inside the account. You only pay tax when you take it out in retirement. The strategy is straightforward. Contribute during your high-income working years, getting a valuable tax deduction when you're in a high-tax bracket, then withdraw in retirement, when your income is likely lower and you'll pay tax at a lower rate. Think of it like this. The government is giving you an interest-free loan on the taxes you owe today, letting you invest a bigger pile of money for decades. That tax refund you get isn't a gift. It's your own money that you can immediately put back to work, maybe by maxing out your TFSA. Part C, the FHSA, the hybrid super account for home buyers. Last but not least, let's talk about the newest and most powerful account for one specific goal, the FHSA. If you are even thinking about buying your first home someday, you need to lean in for this. The FHSA is a beautiful hybrid that takes the best feature of the RRSP and the best feature of the TFSA and mashes them together into one incredible account. Like an RRSP, your contributions are tax deductible. You can put in up to $8,000 a year with a lifetime max of $40,000. That contribution lowers your taxable income, giving you a tax break right away. Then the money grows completely tax-free inside the account. And here's the knockout punch. When you withdraw the money to buy your first home, the whole amount is completely tax-free, just like a TFSA. You get the tax deduction on the way in and pay zero tax on the way out. It is, without a doubt, the single best way to save for your first home. One critical detail: your FHSA contribution room only starts building after you open an account. So even if you can't contribute much right now, it's a smart move to open an account with a small amount just to get the clock started. Okay, you know the tools. Now let's put it all together. This is the step-by-step priority list for every dollar you save. Step 1. Secure the free money. We covered this, and it's non-negotiable. Contribute enough to your employer RRSP plan to get the maximum match. Done. Move to Step 2. Step 2. The homeownership goal. Ask yourself a simple question. Do you plan on buying your first home in the next 15 years? If the answer is yes, the FHSA is your next stop. After getting your employer match, every spare dollar of savings should go into your FHSA until you hit that $8,000 annual limit. That 1-2 punch of a tax deduction now and tax-free withdrawal later is just too good to ignore. For a couple, that's a combined $16,000 a year you can shelter for a down payment, all while getting a hefty tax break. Step 3. The income question. Once the employer match is secured and your FHSA is taken care of, if it applies to you, where does the rest of your money go? This is where the classic RRSP versus TFSA debate kicks in, and the answer mostly comes down to your income. Now, this isn't a hard and fast rule. Your province and personal situation absolutely matter, but a good rule of thumb is around $80,000 of annual income. For 2026, the federal tax bracket jumps from 14% to 20.5% at an income over about $58,523, so an $80,000 income puts you squarely in that second bracket. If your income is below roughly $80,000, your priority should be the TFSA. Why? Because you're in a lower tax bracket today. The tax deduction from an RRSP isn't as valuable. You're better off paying tax now, putting the money in your TFSA, and letting all the growth and future withdrawals be completely tax-free. Plus, you save your valuable RRSP contribution room for later in your career when your income and your tax bracket are higher. If your income is above roughly $80,000, your focus should shift to the RRSP. At this income level, you're in a higher tax bracket, making the RRSP tax deduction incredibly powerful. A $10,000 contribution could easily save you $3,000, $4,000, or even more dollars in taxes, depending on your province. You can then take that big refund and immediately use it to supercharge your other savings, like by dumping it straight into your TFSA. You're playing the long game, deferring tax from a high-income year to a future low-income year. That's exactly what the RRSP was designed for. Step 4. Max out everything else. Once you've funded your top priority account, TFSA or RRSP, the goal is to use whatever leftover savings to max out the other one. For a serious saver, the ultimate goal is to hit the contribution limit on all of your registered accounts every single year. If you're finally getting a clear picture of how this all works, do me a quick favor and hit that like button. It really helps the video reach other Canadians who are feeling just as lost as you might have been. There is a huge, costly mistake thousands of Canadians make every year. They confuse opening an account with investing the money. Opening a TFSA, RRSP, or FHSA is like buying an empty lunchbox. It's just a container. Sure, it has special tax rules, but it's still empty. You have to actually put food inside for it to do you any good. In our case, the food is your investments, things like stocks, bonds, ETFs, and mutual funds. Just dumping cash into these accounts and letting it sit there is a massive error. The real magic happens when your investments grow and compound over decades inside that tax-sheltered container. Don't just open the account, make sure you're actually investing the money inside it for the long haul. All right, let's bring it home and recap the ultimate contribution strategy for 2026. It's a simple hierarchy. Employer RRSP match, grab every cent of this free money, no excuses. FHSA, if you're saving for your first home, max out your $8,000 annual contribution here. TFSA or RRSP based on income. Earning under about $80,000, prioritize the TFSA for tax-free growth and flexibility. Earning over $80,000, prioritize the RRSP for that powerful tax deduction. Max out the other account. With whatever's left, circle back and fill up the account you didn't pick in Step 3. Of course, a quick disclaimer. Personal finance is personal. This is a general framework, and you should always consider your own unique situation.
But now that you know exactly which account to focus on, the next question is, what should you invest in? How do you build a simple, effective, low-cost portfolio that actually grows your wealth? That's exactly what we cover here on the channel, so go check it out. Thanks for watching, and go put your money to work the smart way.